Good morning, everybody. Welcome to Wise Tech for Wise Money. I'm Gary Wayne, founder of A1 Solutions. At A1 Solutions, we work with leadership teams, founders, financial services businesses to improve efficiency, scale intelligently, and grow through smarter use of AI technology and operational strategy. This podcast is part of that mission, real conversation with people who are actively building businesses, moving capital and shaping how money actually works in practice. Today's episode is titled Building Capital Pathways from Research to Transactions to Public Markets. And this is a particularly interesting one because today's conversation isn't about one business. It's about a connected ecosystem. Today I'm joined by Peter Wright, who operates across three tightly linked platforms. IntroAct, a research and thematic origination business. PartnerCap Securities, a broker-dealer and transaction platform. McKinley Space, a SPAC vehicle focused on bringing high-growth companies to public markets. Together they form a full capital life cycle: research, origination, capital raising, transactions, public markets. This episode is about how that ecosystem works, how capital pathways are built, how private companies become investable, how transactions are structured, and how modern financial platforms are being designed for scale. Phew. Well, Peter, welcome to the show. It's really good to have you here. That was a hell of an introduction.
Thank you very much for having me.
Peter, before we talk about the business, it'd be good to start with you. How you came to be, what your journey's been like, and how you got to where you are today.
Yeah, so rare tidbit is I grew up in Anchorage, Alaska, pretty far from Wall Street or anything investment oriented, but even as a young boy, my passion was stocks. I like, some people like wines, another hobby, but, I love stocks, and I love, finding things underappreciated by others that carry, unique value. And I think that's the passion that carries across many people's hobbies, my hobbies, and my passion for the market. Started investing very young and knew that I wanted to get into the investment world. I've largely been a research guy through my background. That's my core passion, is speaking with management teams, understanding how they make money and how investors can make money in them.
At what point did you sort of shift from deal execution to ecosystem building?
Yeah, so what I would say is it probably is a shift from research to transaction. So my passion is research. Was a sell-side analyst at CIBC covering semiconductor stocks for about 6 years, and then on the buy side at Fidelity for a similar amount of time. Same space. What happened in the first 20 years of my life looking at research is I realized that secularly, research was a tough business to monetize. Part of it is that information has just been democratized, and this evil thing called Google has made it much easier for people to get insights. AI is, the next level on that. So getting an information advantage, which is really the goal of an analyst, regardless of the side you're on, has been a tough game. And so monetizing that has been tough. The second, observation that I really realized is research is most valuable at the point of transaction. Investment research is most valuable at the point of transaction. And so that made me take a step back and really look at the value proposition of research and realize that I had to build a research platform that was really focused around providing insight around the point of transaction. And so when doing so, that was the calculus. So IntraAct was the first company that is the core fabric of what we do, focused on progressive industries and really looking at exciting stories, getting them investor ready, working with issuers to get them investor ready. We needed a broker dealer to be able to transact any type of securities transaction, and that's where PartnerCap comes in. And so PartnerCap does, half a dozen to a dozen deals a year is kind of the scale of it. It's a boutique investment bank. And then McKinley is real special. That's the one deal We're given 18 months to get the deal. It's a special purpose acquisition company, which is really looking at the best idea that we find over this period of time that fits the profile of what a SPAC is looking for, which is really, unlike the name might sound, it's not an acquisition company in the sense of a change of ownership where we're acquiring a company. It's really a vehicle to bring a company public and capitalize them with, more capital at a cheaper cost of capital.
You said you started at CIBC. How did you actually get into the markets, and what part of that journey from CIBC to Fidelity sort of made you want to go on your own and put all this together?
Yeah, well, so my very first job was actually at Prudential, acquired a company called Volpe Brown, and so I was part of the program and did that, and I was cranking 100-hour weeks out in my very first job when graduating, and I was watching the TV monitors, and I was seeing the superstars, and I was experiencing 25 years ago the real deal guys. Regulations have changed significantly, but 25 years ago the guys that really drove the deals were the research analysts. And I said, that's what I want to do. My boss at the time said, I've got a very close friend who's the head of research at CIBC. Let me give you a call. This was in 1999 when the boom was hitting, and I was a technology banker. And
was that Prudential Base?
Yes, Prudential Base. That's right.
I worked at Prudential Base.
Fantastic.
7 years in London.
Wow.
And I was there probably to about 1998. I worked under a guy called Bill Schmidt, and I ran all the derivatives, financial futures for London and Europe.
Oh, so you're a smart guy that actually knew how to do math. I was always on the equity side, the storytellers. But
interesting. Anyway, continue. Sorry about that.
So true story on CIBC is we got introduced over to an analyst who was ramping, ex-DLJ guy is who I work for, and he said, look, if you can start next week, we'll take care of everything. Just come out here, because it was 99, there was deals galore, everybody needed starter talent, analyst level, junior talent. You didn't have enough of it. And my boss was accommodating, and there I was. So I was at Volpe Brown, was out in San Francisco for a couple of years, and then flew me out to New York, was living in temp housing for several months, just getting started with him.
Interesting. When you went on your own, what made you decide on platforms over standalone companies as such?
The truth of the matter is, probably my least favorite part of the job, any job that I would have, is really the people side of it. And it's because I don't think I'm good at it. If I can tell a system how to work, I enjoy it. And it's not, it is true that it's scalable and a better business model maybe than people businesses, but it's really a passion of mine. I don't like people problems. I don't like the bureaucracy that exists in some of the bigger companies I've worked with, and never wanted to go kind of the management route. And so I said, if I start something, it's going to be very lean and it's going to be technology forward.
You're running three connected but distinct entities. Tell me a bit more about the structure, just so listeners can understand in a bit more detail.
Structure of the companies.
Yeah, if that's possible.
Yeah, so IntroAct is really organized in a similar way, but different way from what I had experienced, in how investment research is conducted, which is, there's a department where each person kind of runs a franchise or a silo with sector level expertise. How IntraAct was built is every sector has an industry within it, which we call a progressive industry. The progressive industry has two key characteristics. It's typically the fastest growing segment within the industry by a lot, and it is also consuming the most capital. And that's by design that we focus on that industry, because that's where transactions happen, is raising fresh new capital to fund this new growth. So if you look at industrials, it's space, an area that we think is really hot, in 2026 for many reasons. Financials, fintech, consumer discretionary, EV, and mobility. So it's kind of obvious the progressive industries that exist within every sector. But the beauty of it is that we cover every sector. So we get a view on kind of what's going on across the economy, and we see everything with a focus on kind of the growthier, sexier area within every sector. above that it sits a curator, and we call it a curator instead of an analyst because it's really where we believe the market creates value is understanding where the crowd is too, and where maybe the crowd is wrong. So what we really are constantly looking for is two things: trends and outliers. So where is the crowd trending? And so instead of being an analyst and being in the crowd, we try and be a curator, which is looking at kind of the other analysts out there and where they're going. And so that's why we call them curators, and that's an important difference. Is the trends. The other part of it is the outliers. So what we try and do is be first to comment. So our AI is a really good example. Our AI practice started 3.5 years ago, almost 4 years ago now. We've been producing research on AI and disruptive tech. When we started, there was no AI analyst on the street, and that's actually very similar to a lot of the spaces that we cover. Sometimes we're wrong. We get them wrong. Cannabis was a good example of wrong, that it never really took off to an institutional level, but we were early, and we were willing to go into a space before kind of the sell side, if you will, institutionalized kind of investment in that space. And so that's how we look at that, and then the second derivative of that in the curators is really what they're looking for, both public and private companies, is progressive companies. And so progressive companies are different than just being in a progressive industry. Progressive companies have a progressive business model. So they have good growth. Typically a 20% kind of benchmark is what we throw out there, but there's some industry specifics there. The second thing is that they have positive incremental margins. And what we mean by that is it's got scalability. So as a company continues to grow, that growth is a more attractive cash flow stream than what it was yesterday. Tomorrow's better than yesterday. And the third part is capital efficiency. So if you look at kind of the amount of capital it took to get where the business is now, on a sales run rate versus, kind of where that growth is going to be, less capital has to be reinvested in the business. So good growth, positive incremental margins, which means better than kind of the house average margin, and a trending lower capital intensity. And those are the companies that we really focus on identifying that we want to work with.
What about PartnerCap?
So PartnerCap, IntraAct is really a good lead generation tool for PartnerCap. So what we're looking for is to get exciting stories, that we get behind. And PartnerCap is largely entirely a success-based platform. I'm not a believer of retainers on raising capital for companies. And why that is, I'll tell you, my secret is that the most time wasted from a banker is when you know that there's a problem. The market isn't, a story that you represent isn't resonating in the marketplace. So no retainer, you can communicate very honestly and very efficiently, with the client and help them find someone who might be able to help them better than yourself. And so I rather not charge a retainer, be a success-based system, finding the companies that we identify that need capital and say, hey, here's where we think we can really help you. Let's bring this from the secondary market and supporting you, in the marketplace, getting your story built out there, build awareness, build engagement, to a primary, market placement. And that's really what PartnerCap does. Debt placements have been an increasing focus of us, so especially for some of the smaller names. Kind of their first institutional capital, so maybe a step away from some of the venture debt, which looks and behaves a lot like equity, is an area of focus for us.
You mentioned earlier that you went in 3 or 4 years ago, you started looking at AI, etc. I mean, what prompted you to do that ahead of so many other people?
So 6 years ago, actually, when we started IntroAct, IntroAct is an AI company. The first product that IntroAct focused on was an AI product. And I tell you, most customers that we spoke with, their first question was, you talk about machine learning that you use, what is it? And we had to explain, kind of what we are, because everybody had statistics, but not statistics in scale. And so AI and machine learning was not really, well known. Now we've got agentic AI and different derivatives of it. But what we developed as the very first product within IntroAct was something that came from a couple professors out of BU, that they ran a hedge fund. They ran a hedge fund with BU money, And the idea that they had was stocks are a commodity. You don't need to know the fundamentals, the valuation. All you need to really know is how many buyers and how many sellers exist in every stock. And on an equal weighted basis, if you've got more buyers than sellers, the stock's going to go up. If you have more sellers than buyers, the stock's going to go down on an equal weighted basis. Very, very profoundly simple idea that I think is pretty accurate. The challenge is how do you get to kind of that assumption? Who do you know is buying and selling? So we developed, technology that was looking at your base, your existing shareholders, and looked at many different factors and said, what is the likelihood that your existing shareholders are going to be increasing, doing nothing, or selling some of their position? Then a separate algorithm is looking at, the investors that don't own you that are likely to initiate a position. About 80% of the volume in your stock is by your base on average, across the Russell 3000. So your base dictates almost everything. Only about 20% is traders, prop desks, and new investors. So knowing your base is the most important thing, but putting these two things together was an AI product that we first developed to market. What we saw was the journey of being first in the market. There was another competitor that came to market just about the same time of us called Valuation Metrics that was bought by Citadel and basically brought as an in-house tool. I don't think they're commercializing really that tool anymore, but it was true AI. They were a good comp, great people there, and they had a real compelling product. The big guys, NASDAQ and IHS, typically when we analyzed their product, it was statistics. It was, if you're a small cap tech company, let's look at other investors that own small cap tech companies. That's how they did targeting, for instance. And it was pretty simple, too simple. It was not machine learning by any stretch. So we were a factor-driven model. We tested actually 800 different factors. A lot of those are derivative factors and stuff like that. But we had, big number, big data type math, really behind kind of our assumptions on our targeting.
Tell me about McKinley Space then. How did that come about, and what's the plan? Is there a definite plan, and if so, what's the target?
So this is actually the most exciting job and role I've had, in my life. I really have a lot of fun. So McKinley Acquisition Corp, McKinley SPAC, came about really because of what we've done over the last 5 years. So I have commercially supported over 30 other SPACs in different roles: finders, raising capital, capital markets advisory type service. We've worked with over 30 SPACs and target companies, over the past 4 years. What we identified was that the timing was right. The regulatory environment and the current Trump administration in the U.S. is favorable on IPO. Make IPOs great again is kind of a mantra within capital markets, and I think it's resonating. SPACs are a big part of that, for the smaller capitalized companies. When I say smaller, kind of sub 5 billion, really possibly sub 3 billion. Those deals, traditional IPOs just aren't competitive, and a SPAC is much more competitive. We call them better, faster, cheaper, and there's a reason why, each of those is true. But we thought the timing was right. The market was coming into equilibrium. This next wave of SPACs we think are going to be much more successful than the 21-22 cycle, which in honesty was not that successful, as a time in the market looking at kind of that product bringing the types of companies it was. It was just too crowded. There was too much competition, and lower quality deals were really brought to market. But we thought the timing was right. We think we had good experience working with the breadth of SPACs over that period of time we did. And so we created a platform company. So McKinley is the second Belay SPAC. Everest is the first. My partner Adam Dooley ran Everest, and McKinley is technically our second. So Belay is the name of the platform. The belayer when you climb a mountain is the ropes guy, managing your risk, and that's really the platform there, is helping you navigate, the climb to the peak to become a public company. So McKinley is looking, for those progressive companies. So leveraging a lot of the intelligence that we have from the IntraAct team, we're looking for that one deal, about $1 billion deal. Enterprise value is what we're looking for. In 25, we launched August 11th of 25. The back 5 months of 25, we really focused on just meeting a lot of companies and getting our list together. We spoke to 52 companies in that period of time, 52 unique companies we looked at. First quarter of this year, we're really honing in on the ones that we think are most deal ready. And so we have a scorecard that we look at. Kind of fundamentals are only part of what we look at. There's several factors we look at. And so we're getting that short list together of kind of who we think can make a good candidate.
Excellent. You've got separate legal entities for each one. Why that instead of one integrated firm? What advantage does it have to have sort of a modular structure?
Well, so they feed off of each other in our sister companies, and they support each other. So the intelligence engine on IntroAct really services issuers in large. But the reality is that PartnerCap is a boutique firm that is a good fit for some of the customers on the IntraAct platform. It's not a good fit for a lot of the companies that we work with. A lot of them can go to a larger scale broker dealer. And so we separate kind of the intelligence that we work with. We don't want to only kind of relegate our research to the types of companies that, PartnerCap would be a good match for on the capital raise side. So, for instance, we've done research on IntraAct on SpaceX. We've transacted in SpaceX. Would SpaceX ever use PartnerCap as a broker dealer? Definitely not. I'm using the extreme. That's the biggest one that we've done something. Actually, PartnerCap has done secondary trades in SpaceX, I guess, but because of that. But secondary trades will never be a primary, banker, for SpaceX. So being protected under the publisher's rule as kind of a think tank allows you to produce research that is different also than typical broker research. So typical broker research is very buy, hold, sell on these names. It's really not the way IntraAct's research works. So we're much more thematic. When we play a theme, we like looking at the names that are best levered to that. And we don't want to have maintenance research, so we don't want to cover, our curators don't want to cover 12 names in perpetuity. They want to be flexible to kind of be talking about what's hot. And so we run it differently than that. And then the SPAC is very unique. So the SPAC is a transaction vehicle that all the SPACs out there, Cantor is the monster. We're a Clear Street, SPAC. Cantor supports many of these things. Some of the broker dealers have supported their own SPACs, but for the most part, it's a separate team that is looking at the deal, and the investment bank is just helping them find the money and giving them capital markets advice, but not owning the actual SPAC.
Going talking about a SPAC, I've traded SPACs and I've traded IPOs. I mean, SPACs are not very volatile at all. They're coming at 18. They trade up. They might trade to 1850. They rarely trade down, but they might have a very limited upside. Why is that compared to IPOs?
Yeah, so the reason for that is cash is worth cash. So what is a SPAC? And what is the intrinsic value of a SPAC? So a SPAC gets born as basically a vehicle to create a public shell. And there's 4 stages of a SPAC. The first stage is the IPO stage. So we build a team. We raise 2 different buckets of money. So the first bucket of money is risk capital, and that's an operating budget. So that's to pay everybody, all the people who work on I should say Adam and I, who are the deal guys, don't get paid. We're money in instead of money out. We're cash in to the deal. And but we pay lawyers, we pay accountants, we pay all the expenses, underwriters. We pay all the big expenses, the NASDAQ fees, we're NASDAQ shelf. So we pay all of those fees. So in our case, the initial capital raise was about 4.6 million bucks is, what we raised on kind of the risk capital side. Then we raised trust capital. And that's that $172.5 million that is sitting in cash. And so your question is, why does McKinley stock trade at $10, $10, $10, $10, and then it'll have a slight positive bias until we announce our deal. The reason for that is there's no knowledge that anyone has in the public markets about McKinley and what we're doing until we announce a deal. So because of that, no one's going to give us credit for potential deals. There's some repeat sponsors that have done deals that may be traded at a slight premium and stay at that premium. But for the most part, what we're valuing is the cash that's there. So you have the ability to redeem it. In our case, 18 months after our IPO date, we have to have a BCA to stay alive. Otherwise, our trust investors can redeem their capital. They can say, give me back my money. And the way that trust capital works is, they give us $10. It's put into money market. It's 100% pass through. So they get all that money market money back. In addition, they get a right. They get a tenth of a right in our case to have given us the money. It's the easiest thing. I don't want to take anything away from our underwriters. We love Clear Street. We'll work with them again. They did phenomenally well for us, but it was 5 times oversubscribed, the trust. So, for 172, there was over $1 billion of demand, for our specific deal. It's really easy to raise the trust capital because it's kind of like you get free money. I could put the money directly in money market, or I could put it in this trust, get exactly the same benefits as the money market, but in this case, I get that added right. So it's a very easy sell into the marketplace. The risk capital is the hard part, to raise. The second phase of the SPAC is the search, which is where we are right now. Third phase is executing on the deal. And then the fourth stage, which is very important, is the de-SPAC. So that's really the first day that the company starts trading with a target embedded into it. And they're very volatile. SPACs, RTOs, direct listings, if you look at those categories of different ways you can go, SPACs have actually outperformed, but they're volatile. So it's very different from that $10 kind of path that you referred to on the SPAC side.
Just going back to what you mentioned earlier about involved with progressive industries, how do you define what a progressive industry is?
So the primary thing we look at for progressive industries are they growing and are they consuming capital? So, and those two things are synergistic in some way. So when you're growing, are you growing and just distributing cash? That's a cash cow, and that's gonna peter out. Just the way the world works and capitalism works, at some point you're gonna mature very quickly if that's the model. What's very exciting is when you're a growth company that requires more capital to scale, and that's got a multiplier effect, and you trade at richer multiples when you're doing that. And so one of the reasons we like progressive industries is there's a very large private to public multiple discrepancy or arbitrage opportunity in these industries, for the reason that when you really have, if you're in a progressive industry and having access to abundant capital that's cheaper, than in the private market will create a multiple expansion opportunity when that happens. And so the SPAC is looking to capitalize on kind of that arbitrage opportunity, take some of that delta in enabling that target company to take advantage of it themselves.
Well, so what makes a company transaction ready versus just interesting?
Great question, and this is where different SPAC sponsors are maybe different, but I will give you kind of our playbook. So we have a scorecard that we look at, and when we meet with a company, we are a little more quantitative about it than the average team, I think, in a significant way. Fundamentals, the progressive fundamentals that we talk about, growth, profitability, and capital efficiency, that's only about 40% of our equation. So the other aspects of it is kind of the transaction capability. One, disadvantage that SPACs have is time constraint. It is a transaction vehicle that has to get a deal done in a given amount of time. And so, when you ask a SPAC sponsor, company A has better fundamentals than company B, do you inherently like company A better than B? The answer is not necessarily, because company A might not be, ready, institutionally ready and public company ready. So they might not have governance, they might not have the audits in place, they might have things that just are going to create a very long, system to get it. So two other aspects to think about is kind of the structuring of the transaction. So is the value right on the company? Are you able to kind of price this thing right? The other aspect is it a space that's familiar enough that you're going to be able to get participation in a pipe or, in the capital markets among institutional investors? So what is the money that is validating this transaction from day one? So that's the second thing we look at, is kind of the structure of the transaction itself, the money that's coming in, validating the idea, and the valuation itself, and kind of context of the marketplace and valuation. The third bucket that we look at, which is maybe a little unique to us, is what we really call our soft look. So as I mentioned, we worked with 30 SPACs, over 30 SPACs. 8 of those failed. And sometimes you learn a lot about the ones that fail as opposed to the ones that don't. and meaning they didn't SPAC. So 8 of the mandates we worked with were with failed SPACs. And
So can I just ask a question? So you see the SPAC is listed on the exchange.
yes,
If it fails, then it comes off the exchange.
it comes out. Yes. So if it fails, it's basically saying, I'm going to redeem your money. The trust gets their money back and the SPAC comes off the exchange. That's right.
Okay.
Yeah. And the only people who lose money in that situation is the risk capital guys, which is largely the management team. In that situation, the trust guys will make money, on that situation still, even though it failed, to just be clear on that. The third bucket, though, that we really look at is the company ready, worthy, and eager? So readiness is kind of that PCAOB audit, and the ability to answer to shareholders on a quarterly cadence. So private companies are great at dreaming the dream and talking to investors about how great they're going to be in 5 years from now. In the public market, unlike the private market, you could buy the stock tomorrow. You don't have to wait for the next capital raise, which might be 6 months, 1 year, 18 months away. And so what that does is it forces public companies to operate more on a quarterly cadence. And a lot of people can say that's good or bad, but that's what you're signing up for when you're a private company, whether you like it or not, is every quarter you've got to be able to manage a story that is hopefully better than it was 13 weeks ago. And so that's readiness. Worthiness is really, does it have a comp group? Does it have a space where institutions have a place in their portfolios that are waiting for this type of asset to come into it? So it can't be too archaic. It can't be too different. There's got to be comps, that tell an investor that we have a box to evaluate this type of asset. And then eagerness. And this is one of the early filters we look at. And of the 8, majority of them failed for this reason. I believe, because I was there and looking at it. 6 of the 8, I'll tell you actually, I won't name the 6, but I sensed early on as a service provider into those that the deal had tremendous risk because the target wasn't sold on the idea. They were testing it out, exploring it, but they already were kind of 1 foot out of the deal. So at McKinley, eagerness is critical. So we don't want to pull, a target in. We want to work with only the companies that are coming to us, and it's not an arrogance thing. It's just we're time limited. We'll explain the virtues. We'll defend what we have. We'll defend our value proposition. We can negotiate on every aspect of it to promote and whatever else. But one thing we can't negotiate on is, do you want to be public? You've got to come to us knowing that you want to be public, and then we can start the conversation about, if McKinley is the right SPAC for you.
Excellent. So IntraAct feeds the other 2 businesses. PartnerCap raises the money. And how does that physically work? Is there 2 different teams, etc.?
Totally different teams. So I am the only person that overlaps at, there's one other that overlaps at IntroAct and PartnerCap. And I'm the only person that overlaps at all with McKinley. So it's kind of a me thing that has these 3 things together, but the rest of the teams are different. So there's 15 or so people on the IntraAct side. There is about 9 people on the PartnerCap side, and there's four officers and 3 board members on the McKinley side. No overlap between those people other than me and 1 person that's interacting.
Well, when you're raising capital via PartnerCap, how do you decide what transactions are worth looking at, etc., and the deal profile you typically operate in?
Yeah, so we don't charge a retainer, so it's high risk. And so we look, the single stat that we judge ourselves by the most is our batting average. So when we take a mandate, our time is our most precious resource, like every person. And so, when we take a mandate, we have to have a pretty high level of confidence that we'll succeed on it. And so one of the things that we really do is we've got a commitment committee that reviews it. And in that conversation among, the 3 partners is, do we already have somebody who's going to accept this mandate from an audience perspective? So we've already kind of soft pedaled it, that we know someone's not necessarily in the deal. We don't know that most of the time, almost every time. We don't know that they're in, but we know that they're going to look at the deal. So we have hopefully what we call a Schedule A of people that are identified targets that some of those conversations have already kind of softly happened on a no names basis. If we have this type of profile, is this something you'd look at? What would be your concerns when looking at? Some of those conversations happen before we accept a mandate, so that we know that we're going to have an audience out there for the mandates that we bring forward. I will give you an idea. We work on I gave you about half a dozen or so wins a year. We probably work on about 15 a year. So that gives you a good ratio of kind of how many times we win versus not. And our goal is 40%. We want to win on at least 40% of what we work on. We're right at about that number.
Where do most deals fall down?
That changes with the time. That's actually a really good question. So does PartnerCap have kind of a core area of expertise? Yes, but it's dynamic, it's not static. What we're really good at is looking at things that are kind of new ways to finance, and not brand new, but kind of relevant to the times. And so what we aren't is kind of the cookie cutter guys that are, and I'm speaking more for myself than a couple other guys at PartnerCap, but what we aren't really is kind of we do Series A equity finance, or we do private equity placement work. We aren't kind of the cookie cutter guys that spend 30 years doing that. What we do is we evolve with the time. So equipment finance and trade finance are things that we've got that Rolodex together, and those are things that we can kind of bring to our clients together. On the debt side, it's a little different because we've got that Rolodex that we can bring to the clients when it fits. But our areas of expertise really kind of change with the times. We look at what's hot and we go after that. So IP lending was really hot for a period of time a couple of years ago. So we had a pretty big effort at kind of going after IP lending. Right now, it's interesting. What we're looking at is a lot of the spaceport bond issuance. So we're not a municipal underwriter at PartnerCap, so we actually have identified another municipal firm that's got a deep expertise, and we're looking to partner with them on some of these spaceport bond opportunities. So like an airport or a port, these municipal bonds, what the big beautiful bill opened up at the fourth quarter of last year is money to go towards space companies that are around these 15 spaceports in the country. We think that's going to be a big bucket of money that's going to be very attractive to a lot of the progressive companies in our space vertical, and that's a big area of focus. So we're chameleons. We change with the times, and we go after kind of this sexy new product, try to become experts early on in it, and then get several trades in it.
How does PartnerCap charge or make its money?
Yeah, so it's always on a success-based system. So no retainers is the system on the banking side. Placement is different. If you're placing for a fund, there's retainer work there. I don't work on any of the placement stuff myself. But on the banking side, depends on the company. Fees typically scale down as you work on bigger projects. On the debt side, you would never come to us to place you with a commercial bank. So if you can get commercial bank debt, you don't need to work with us. You can go to your local bank and get it. If you come into kind of our private credit lending network, we're going to probably get you more availability than what you're going to be able to get on your own. And that's the value proposition. Typically on debt, depending on the size, between 2 and 4% would be an international kind of high quality, high focused deal, but 2 to 4% on the debt side. On the equity side, smaller deals, and I'll say smaller deals are kind of sub 20 million. Anything sub 20, you're probably looking at a 6 and 6, maybe a 5 and 5 type situation. So what that means is 5% of the cash we raise, we get, and then we get warrants of 5% as well. Once you get above 20 million, those fees start coming down quickly. And typically a big deal, is what our focus is every year. One big deal, maybe 50 to 100 or more. On the debt, that's on the debt side. So on the equity side, 50-ish million is a big deal.
Moving on to McKinley's, where are you now with McKinley's?
We are in the search phase, so we're in the second of the 4 phases of the SPAC. Knock on wood, but we are very comfortable with where we are right now. So we've met a lot of companies. The way we run it is we always have our 10 best ideas. Any day that you've hit us, really from the day we IPO'd, we've had 10 ideas. We've had at least 10 ideas that are possibly there. That's been refined. So we entered this year feeling pretty good about our 10 best ideas. The way we approach it is not that we're looking for the best deal. We have our best deal. We do have one that sticks out as kind of our favorite idea. They're raising a lot of money right now, and there's other things that we might be helpful to that company and doing in the interim time. But we're not going to wait on the McKinley transaction. We're not going to wait for this vehicle for our favorite idea. As soon as we got a deal that we feel confident that we're going to be able to bring to market and will be a successful trade, we'll execute on it. And there's about 10 names right now. There is 10 names right now that we're looking at that we think any one of those could be, the name that we pull forward.
I think you mentioned private and foreign listed companies are ideal targets. Well, why is that the case?
So that's evolved actually since the IPO. We approached it industry agnostic, geography agnostic. Interestingly, we do like the international names a little better than maybe the U.S. names as a bias. And the reason for that is a weak dollar. So we do think that the current administration, U.S. administration, is a weak dollar policy mandate. Stronger exports. There's lots of reasons I think they're doing it. There's got risks on that. That's a different conversation politically. But what it's really doing is some of these companies that we're tracking internationally that maybe had, I'll use simple math for the illustration. Maybe they have $100 million of EBITDA as a target when we were talking with them in the fourth quarter. They measured it in euros, but on a dollar conversion, let's call it 100 million. Now all of a sudden that's 110 or 120, partly because things are getting revised up a little bit. We're seeing they're tracking very well, but a big part of that is translation. That's making some of these names cheaper on a U.S. dollar basis and more attractive than it is. Internationally, the markets are also just doing better. So it's not something that is that difficult of a call to get confidence behind. Right now, the U.S. is lagging a little bit. That's a good thing to come to the U.S. market at times like this, establish a base, because that's not. I'm American bull. I think the American market over the long time is going to continue to outperform by a large degree, not marginally. But right now, cyclically, you're coming to the market at a very good time because you're going to get that catch-up trade, we think, in the next couple of years as well.
Okay, talk to me a bit about capital augmentation and how it works.
Capital
augmentation.
So that's very interesting in context of the SPAC. So if you think of like a traditional IPO, typically if you hire Morgan Stanley or JP Morgan to run a book for you, the way that process works is they come to market and do their roadshow and they're building a book. And typically they won't price the deal. So you won't know exactly what the price is, what the valuation is, and you won't know how much capital you raise until you're out there. But you really want to build the book 3 or 4 times more than what you're pulling day one. Okay, and that's the reason for that is so there's secondary market support. So when you price that day one, days 2 through 10, there's already people who wanted more of the stock than was given to them upon the IPO. And that supports kind of buyers in the marketplace. SPACs, this is probably the biggest negative of SPACs, don't work that way. So when a SPAC comes to market, the secondary market isn't really there to support them. And so you raise the capital to get the deal done, and then there's a race that happens in the first year to build awareness and build engagement and build kind of the secondary market behind it. There's some things you can do to prevent that. Building a syndicate, getting capital markets advisors to build, deep roadshows for you ahead of time. We have witnessed, kind of the market is reluctant to spend too much time on SPACs until they start trading, and then the market is open, then it's officially a done deal, and the confidence is there. We hope that starts changing. We see some signs that it's starting to change. The reason we see it changing is the pipe market is getting a little warmer. Raising capital certainty, is getting easier and more real for these companies. And what that does is make them confident that these transactions are actually going to happen. there were so many failed transactions in the last cycle that investors just said, I'm not going to invest time until after the company is trading publicly, and then I'll invest my time in it. So building that secondary market was very tough in the last cycle. It's getting easier now, and the confidence is building. But I bring this up for augmentation. Because of the mechanics of a SPAC, you want to raise a sufficient amount of capital to not be a short target. And what I mean by that is, the easiest short in the world is a company that needs to raise capital to survive, not acquisition capital or growth capital, but survivorship capital. Any name that has to raise capital in the near future, that's an easy short candidate. There's loads of institutions that just make money stepping into the short side of that right ahead of that trade. So you need to make sure you raise sufficient capital for the trajectory and life cycle that you need. But you don't want to be greedy and sit on coffers of cash. Because it's dilutive and it's hyper inefficient. So the original capital you bring in at the time of an IPO is your most expensive capital you're going to get. So what you the liquidity isn't there. So really what you want to do is, from an augmentation perspective, is raise the right amount of capital for you. And there's mathematical ways you can kind of look at that, but have a plan to raise future capital for future needs. And that's an attractive thing. A secondary is a very good thing to have because it's a catalyst to bring new investors into your stock, to drive your float, to drive trading activity, which therefore creates a multiple expansion opportunity for your story. So the augmentation question is not just a banker or a SPAC sponsor saying, make our life easy, don't raise any more capital you need. It's actually a very strategic piece of advice saying, don't take more than you need, because you're going to want to raise some capital in a secondary 9 months, right, 15 months down the line.
When you step back and look at your business, what you built is a capital lifestyle model. How does that scale? Is that easier to scale than traditional investment firms?
Yeah. Well, so there... People are always the bottleneck in this type of middleman business. And AI is really something that is changing that in a big way. So I'll tell you, I'll take it one of the three. I'll focus on IntraAct to answer your question as an example. It applies to all three. Scaling this business is tough because you got to get a good expert, you got to get a good space, then you got to get a following to kind of make it worth kind of scaling into a new area. Probably the biggest secular shift in research that's going on right now is the dynamic of push to pull. And this isn't an IntraAct specific type situation. This is a market thing that we all have to be aware of. So research, there's a saying that research is sold, it isn't bought. And what it means is that the provider of the research figures out what is important and gives it to you in reports or commentary or different forms of media. And what AI is changing is the push versus pull dynamic. It's now much easier to access research on a pull-driven basis. So don't give me your stuff that you think is important. I know what questions I think are important, and now I have the ability to access that intelligence that's most valuable to me when I need it. So that secular shift is doing one very good thing for every research business out there. It's forcing them to be more technology aware and technology savvy. It's also creating a much more scalable platform. So when you start making that shift, what you're embracing is AI agents to support kind of your application layer of intelligence, which is human in our case right now, and that's hyper scalable. So that's one example of where AI is really changing the middleman.
Has it made it more competitive? Because I can go back, as you can, to the days when Goldman Sachs, all the big banks, gave you research just because you're a client. Then they changed their model and started charging for it. And now, obviously, people like Bloomberg obviously offered it free as part of the service. And then now AI can source research all over the place. So it must have changed that landscape hugely.
Yeah, I'll tell you, we don't have this yet. So I'll tell you one thing we're looking at kind of, we're doing research into is what I would say right now. If, let's say you're an investor at a big institutional investor, and you have questions about an investment that you have, where can you go for that on that pull-driven model? Well, a lot of people are going to go to their favorite LLM, ChatGPT or Grok or whatever they're going to go to, Claude. And what we're thinking about is how do we compete? How do we become that destination that they come to instead of the LLM? And what you need is you need an application layer on top of it that provides expertise. So you think you have good questions, but is there a way that we can make your prompts or make your questions smarter and more encompassing to really get at the heart of the value creation that you're looking for? And so I think research analysts and embracing AI in one of the earlier stages that's going to happen here is really it's about helping your audience ask the right questions so that they get the most insightful answers. And to test those answers and understand once they get the answers, where can they go wrong with those answers and understanding the risks, which is often forgot, as part of it. So that application layer of, if I come to you for an answer, how are you going to optimize my alpha and de-risk me as much as you can in this instance? That's the technology that is very scalable, still needs human intelligence in a big way, and is a layer that is very valuable that can sit on top of the element.
So what about you've got legal chat GPT now.
Yes.
You've got all these specialities emerging within the app and platform world using AI. What about forming a research app on AI that people can subscribe to and then pay up, level up and pay more for additional information?
That's it. So, if you think of a swarm of AI agents, think of like a research department in a cloud using AI. So you'd have a dedicated AI agent to really focusing every day on getting smarter within that industry. And that's that AI agent's mandate is get smarter, learn, cross-pollinate expertise as it applies to this one space. You don't need to become a cross-sector specialist. That's another layer on top of it. What you need to do is this AI agent is just space, let's say, or just fintech. We want you being the smartest AI agent in the room on everything that moves financially for that space. Then the swarm is all of those AI agents working together, and then you've got a discipline where where the real value is where do these things intersect and how do these AI agents work together. Then you're building some intelligence that is not really derived from the human research department. So it's better. You can create a smarter, better research engine today than what existed yesterday.
But when we go back to your ecosystem, how do you sell and explain how it works to investors and institutions, etc.? How do you sell your services?
Yeah, so very simply, we start with understanding what their capital market strategy is and making them realize that where they are. Everybody's different on their journey, but what we enable is investor readiness. What we help you do is become more investor ready. And depending on where you are, what you have and what you don't have, we can help you figure that out. So it's modular. So, selling yourself to investors is the same 5-step process that is universal in selling anything on planet Earth. So the first thing is benchmarking yourself and understanding the landscape. So if you're selling your stock, whether you're a private company, public company, it doesn't really matter. What is my audience saying to me? If I'm selling them my stock or I'm raising debt from them, they're saying, why you? Why now? And if you convince me, what are the KPIs that are going to be very important to me to make sure that I get out at the right time? Because I never make money when I give you money. I make money in the future when it's worth more. So why you? Why now? And the KPIs. That's benchmarking. So that's the first step in the 5-step process is having a very good answer to all of those. The second is messaging. There's static messaging and dynamic messaging. We focus more on the dynamic messaging for most companies. So static messaging is your elevator pitch. How do I make money? How are you going to make money in me? Your investment thesis, which is on top of the elevator. Different companies have both those pieces. What they don't typically have, and even large companies, multi-billion companies don't really have a good handle on this yet, is dynamic messaging. So when you start selling to institutional investors or any client, you've got to stay relevant. And so if you're going to go walk in the doors of Fidelity every 90 days to keep that relationship warm and hopefully help them build a deeper position in you, are you going to come and tell them the same story? Well, of course not. So what is evolving? What is more exciting today about your story than was 90 days ago, which is the catalyst for them to increase their position? This is dynamic messaging. So coming up with a strategy that is real, it's not fluff, real substance that has a quarterly cadence to it. And that's the art of dynamic messaging. Every company can do it. Even a biotech company that doesn't have fundamentals behind it still has the ability to create dynamic messaging, but it's difficult and takes a lot of time thinking through that. One of the things that companies do really well is think of press releases, and they typically have a spreadsheet somewhere within their institution of what press releases are coming out. They don't do the same thing on the IR side of their house. And so dynamic messaging is how do you translate that in a similar way of what you're going to be communicating to investors. Third step is targeting. Who should I go after? Now, I've benchmarked myself. I have my messaging. Who do I give it to? This is where a quantitative, machine learning product comes in to tell you who you should be getting your message out to. The fourth step is awareness building. This is where research steps in. It's a very effective tool at validating the target. So the most effective way, our targets aren't always right, of course, as you can imagine. So it's got a percentage of accuracy, but it's got a percentage of inaccuracy. So can you pick up the phone or can you send custom emails to all these people? Of course not. The best way to do it is passively observe their behavior. So when you send out research and you see who bites, who's reading this research, those are the ones that you want to follow up with, which is the fifth and final stage, which is engagement. So when we come to the market, we say we're capital markets advisors. The first step is to understand, where you are on your journey and how investor ready you are. Where are your holes and where can we help you? And if they're lucky enough to kind of fit PartnerCap, we'll help them with that, but we'll also be the agent, the quarterback that will actually execute that race.
So what's the future look like? What's the plans for the future?
Yeah. For
Going
us.
forward a couple of years, 3 years. What's beyond McKinley SPAC? What's the next stage?
Yeah, McKinley is part of the Belay platform. So, the journey is really, we see helping. My goal is that in the future, we have helped many companies achieve more abundant capital at a cheaper cost over their life cycle. So repeat customers that come back to us and say, you got us the toughest one, which is our first institutional round of capital. And so we're coming back to you for the easier stuff, those secondaries that everybody fights for and is easier money to raise. That's one thing that we want to get better at is kind of customer retention and kind of life cycle investing, which we've had a couple wins on that side, but there's always room for improvement there. But I think that's really the goal here is to be able to look back and say we have helped many innovative ideas properly capitalize themselves and reward the entrepreneurs behind them, helping them maintain the maximum amount of capital and ownership in their ideas.
How will you continue to grow using AI and new technology? What's your view on that?
We are AI heavy, and not only by culture. Actually, I would say everybody on the IntraAct side for sure uses AI every day. We really do. Is kind of culturally, we're very aware. We're trading comments and experiences of different things that we're pushing through to AI in different ways. So we're a good beta culture for using AI. What I can tell you in the answer to that question is, if I was to answer the same question a year ago, what do I think AI is doing in my day-to-day routine? I wouldn't have scratched the surface of actually knowing what it is actually doing. The evolution of AI is happening so rapidly and so much more of it is being done by AI. It's amazing. I will share with you a secret, that we don't really kind of advertise out there, but we used to be a little more sensitive about this. It's so obvious now there's no need to really be secretive about this, anymore. Think of an initiation report. An initiation report on a company you're familiar with. Typically a 30-page deep dive piece that goes through their filings, their website, talks to a bunch of people to aggregate, bunches of intelligence. Those reports 3 years ago used to take us about 80 hours of human time to create. a financial model, is behind it. That's a chunk of that time. 80 hours. And about 10 of those are a senior analyst who's engaging, with the management team and competitors and suppliers. The other 70 is secondary research, which is a junior analyst manufacturing everything else. So it's about 10 and 70. That 70 hours right now, we've got down to about 1 hour using AI. That's what's happened here. Now you say, what about the other 10 hours? Not going down by the same magnitude on a percentage basis as the secondary for us yet, but it's still significant. Because what we're learning is kind of how an analyst should manufacture research and what is the playbook, and is there ways that you can kind of run this on a systematic basis. And once you figure out that systematic basis of what you do in manufacturing an initiation report, for instance, AI can just do it better than the human.
I'm with you on that. So tell me about automation regarding origination and transactions. How does that help?
So there's some other platforms, not ours, that we're aware of that we're using on that. There is a lot of, we're not necessarily the technology face behind it. We're users of that type of technology right now. One of an interest, there's a couple guys that, I won't name the names of what we're doing unless you want them here, but there's a couple guys that have offered very intelligent solutions to us that we've looked at. I'll mention them, give them a shout out. There's a group called Exit Path that we've looked at, their technology. They have some very interesting ways to kind of look at deals and organize you in very efficient ways, looking at kind of not only how to position it but where to put it. And it's a platform company. There was another company that we came across fairly recently called Capix. We're not a customer of these guys yet. I think we will be pretty soon. And we're testing their technology, but it's very exciting what they're looking at. And so they're using AI in a smart way. They've got lots of different data that feeds into it. Think of just the data costs that they're saving. If you have to buy PitchBook and Crunchbase and all these different subscriptions individually, and I don't know if it's going to replace all that, but it's hundreds of thousands of dollars of data. These guys are synthesizing it, so they're not only paying for those subscriptions where we don't potentially need access to it, but they're synthesizing it to the answers that we care about. So if we're representing a deal and we're saying who are the most likely buyers in this type of deal, and they spit out kind of a, here are the top 20 and here's why, this is the last transaction that we're done. Think PitchBook, and how you use PitchBook. Imagine that being automated for you, where there's this layer of intelligence. That's what this company is doing, and it's everything is getting automated if you're a middle person.
So before we wrap up, I mean, if you had a magic wand, I always ask this question, and you could change one thing in the capital markets ecosystem, what would you change?
Shorting.
First.
Easy one for me. Shorting rules, naked shorting specifically. I think it's very un-American. I think it's a horrible idea that is just not policed well. So I'm not saying you shouldn't be able to short. I do think companies should have to deal with kind of a shorting capacity, but what I really wish is that regulations came down on naked shorting, because you're stifling growth and you're penalizing companies that lack scale or lack liquidity. It's a horrible thing in the marketplace allowing this. It's killing companies.
You see a lot of that still, because you have the borrow books, but a lot of the time you can't get the borrow.
And still there's companies that have short interest that just obviously can't be understood. Just look at some of the trading volume on some of these names. Every share is being moved over 20 times and regulators aren't doing anything about it. I don't know why.
I thought they monitored every transaction.
Yeah.
Okay, well, that's been great, Peter. I really learned a lot today, and it's been, I've really enjoyed this conversation. It's something near to my heart, and I've learned a lot from you. If guys want to get hold of you and they want to talk more about what you're doing as a company, how do they get hold of you as an individual and a company? Or
Fantastic. Companies, yeah. So if you are a private company that is contemplating, transition to public company, we would love to have a conversation with you on the McKinley side. And any of the emails work, but Peter at McKinley SPAC, McKinleyspac.com. That's us, McKinleyspac.com. We'd love to talk to you there, and if you're exploring kind of your capital market strategy and want to just have a discussion of where we might be able to help, Peter at IntroAct.com is the best, and we reply very quick. And if not same day, within 24, 48 hours, you should be getting a reply back.
Fantastic, Peter. Well, I want to thank everybody for listening. I want to thank you, Peter, for being on here today. If anyone wants to talk to McKinley, you know where to go. If you want to talk to A1 Solutions, I'm on LinkedIn and on my website as usual. You go over social media platforms. We look forward to you tuning in again for our next episode. Peter, once again, thanks for having the time to be here, and it's been a pleasure.
Thank you so much, Gary.
It's been a pleasure.